What's up, everyone? Eric here. Welcome back to the Outlier podcast. I have David Hunter back yet again for another update to see what he's seeing in the markets. Welcome back, David. Great to see you.
Yeah, great to see you, Eric. Thank you.
Of course, we had a chance to talk really quick. I heard that you are enjoying the northeastern weather. It's not humid at all or anything like that. It's just perfect.
Yeah, typical New England weather. It's in the 90s, and I think today they said it feel like 100. So we're getting our summer weather. But hey, just wait a minute, it'll change.
I know I tell you what, that is the good thing about the Northeast, isn't it? Is that if you don't like one of them, you just wait a month or two and then it's going to look real different.
Yeah, definitely.
Speaking of looking real different, a completely unintended segue, but a perfect one. The last time we spoke, the markets looked quite a bit different than what they do now. And I mean, realistically, in the past week or two, things have started to capitulate pretty meaningfully. So I figured that we could start with a little bit of a gap analysis from your perspective. From the last time we spoke about a quarter ago into now, what are the main themes that have transpired from your perspective?
Yeah, I think the big one obviously is that the economy is showing more weakness. It's showing signs of slowing down, and inflation's also trending down. So, we came into this year expecting that. First quarter surprised people with higher inflation numbers, and everybody went from expecting 6 or 7 cuts this year to, more recently, are we going to even get a cut? So I think what's happened in the last couple months is you've gotten the softer economic news again. And again, I keep stressing this, that nothing is a straight line. These are not linear things. And so the economy isn't either. You're going to get statistics that, and as well as with seasonal adjustments, it makes it harder to get real numbers. But you're going to have ebbs and flows in all these data. And yet, both the street and the Fed tend to, look at this data as if it's a given. Oh, look, inflation's ticking up, so we got to go the other way. And so they went from 6 cuts, or at least that was what the street was expecting, 6 or 7, I can't remember, to where the Fed was talking about maybe we won't have a cut this year. Most of them were still talking 1 or 2 cuts, but and then all of a sudden, in May and June, and into July, we've had some numbers that confirm that the economy is continuing to slow and moving towards recession, in my opinion, and that inflation is ticking down. You've got that trueflation number out there, which is a private number that supposedly has had better track record than the government figures, and that's coming in at just under the Fed's target of 2%. The PCE deflator, which is the Fed's favorite inflation gauge, came in at 2.6. So we're not far away, and Powell's stressed over and over through the year and before that we're not going to wait until we get to 2%, because by then we've probably waited too long. In fact, he just said that again this past week. So I think that's pretty much telling you we're at the level where rate cuts can happen. I've even said we could see a rate cut at the July meeting, which is the last day of this month. You still got 2 weeks of data to come, so we'll see. It's not the expectation of the street. The street's expecting a September cut, and I think the probabilities there are 80 or 90%.
Sitting at 100 now.
Is it 100? Yeah. So, yep. But what's the July number? Do you know?
Yeah, right now it's showing 6.7% probability of an ease, 93.3% probability of no change, 0 for hike.
Yeah, so that's where the street is. I would not be shocked to see a cut. It would surprise, and I don't think Powell's not going to wait until July 31st and then spring it on you. I think the odds are, if we're going to see a cut, we'll know it as we move into the end of the month. So, if we continue to get some weaker numbers here, then I think a cut is a real possibility. If we don't get numbers that really say that, if they're kind of marking time, then I think we just wait till September. But again, the likelihood is it's a quarter point. It's possible if we wait till September, it's a half point, but the likelihood is a quarter point. people are, I've seen that narrative around that if they do it in July, it's going to send a signal that they're panicking and something's wrong. The economy is worse than expected or something. For a quarter point cut, come on, people. It doesn't matter really all that much. It just would be starting the clock a bit earlier. And I do believe the Fed is overly restrictive and that we are running the risk that they've stayed the party too long here on the tight side. So if it were up to me, I would say they should do it in July. Obviously, that's not where the street is right now, and the Fed has not sent any signal to the street that that's likely. But I think in the next couple of weeks we could see us build towards that. I wouldn't count on it, but I think it's a possibility.
Yeah, I see your angle there. Two questions to probe into from a general learning perspective for people. You mentioned that the PCE deflator is kind of like the Fed's go-to tool. Why is that?
It tends to be more stable. Consumer price index bounces around a lot. So the makeup of the PCE tends to be less up and less down, not as volatile. So I think they feel it's a more representative number. You can react to these big swings, and it isn't probably the best thing to do. So it's just over the years been the one that they feel is probably a better indicator.
Yeah, that makes sense. And then the other thing I wanted to ask you about was last time we spoke, you had mentioned that you had felt that we might have been getting to the point of being over tightened, and that was about a quarter ago. How do you think we've fared since then? And what impact do you think maintaining the current policy, that additional quarter, and then potentially, another couple months before we do cut, do you think that that drastically increases probability of some sort of whipsaw effect? Do you think it's like moderate probability? How do you view the impact of keeping rates where they have been for the duration they've been?
Yeah, this is an interesting one because there are lots of people out there still saying we don't need cuts. Why would they cut? And then you got people like me saying, no, I think we're closer to recession than people realize. In fact, I would not be surprised at all that when the NBER, the National Bureau of Economic Research, who are the official determiners of when a recession starts, they don't really date it until after the fact. Once we're in recovery, they'll look back. But I would not be surprised that when they go back, that they'll say the recession began before this. So we could have been in recession in June even. We're on the verge. I think a recession is anytime between June of this year and this fall. We may already be in it, or we may be just heading towards it. But the problem is leads and lags, and by the time you react to that, if you wait, you're basically a year late. At least 8 or 9 months late, maybe a year late. So, and with the momentum of something, if it starts deteriorating, then it just starts picking up speed like a snowball going downhill. And so, by the time your policy starts gradually, and then you increase it as you go. You're just stretching out the pain. And if your objective is soft landing, which Powell claims it is, and it should be, um, you're running a risk when you wait too long that not only is it not going to be a soft landing, that the amount of stimulus required to pull you out of that hard landing is going to jump up another inflation cycle much bigger. So, if you do it kind of right, which is not probably realistic because the Fed never does it quite right. But if they did, you're easing just as things are slowing down to that almost to the recession point, but you turned it before you got there, and you don't need super stimulus to get you out of it. It just turns it back in the other direction. That just doesn't ever happen. We've seen cycle after cycle. The Fed stays the party too long on the tight side, and then over eases because of the crisis they create, and it leads to another inflation cycle. So that's my concern, is that that's where we're at. Um, you know, Again, it's a quarter point. Is it going to make a drastic difference whether they cut now or wait until September? Probably not. But if you can get it started now, you might avoid some of the real downside that I think is coming. Now, I'm calling for a global bust in the next year. So I don't have a lot of optimism that they're going to manage this correctly. But that's the hope.
Got it. Recently, there was a couple Fed speakers that were even talking about potentially raising rates, and we saw a few comments of that in the last couple weeks, which I thought to me looked more like messaging, but I didn't fully understand the comments and why they would come through that way as compared to maintaining the very data driven decision making that really Powell has been focused on. I was surprised to see that. Did you take anything from that? Does it mean anything to you when some of the other committee members say stuff like that?
Well, I will say there are, different voices on the FOMC. I truly, and I've said this to you before, I truly believe Powell, and I think same thing pretty much for all of the FOMC members. I think they're straight shooters. They are giving you their view of things, and rightfully so. There should be different views there. What you don't want is groupthink. So I can understand. I don't agree with it, but I can understand the narrative. The concern for those people is if we don't get inflation down and get it down for good here, or get it down to a level where it's really been taken care of, we run the risk that we ease prematurely and inflation heats up quickly, and we're going to have a harder time second time getting the genie back in the bottle. So I get the sentiment. I think they're wrong. I think because of my 50 years of watching cycles and watching the Fed, history tells you the leads and lags are longer than they realize, and that they react too slow, and it ends up being it leads to extremes of boom and extremes of bust. So I also think um, there is, whether they admit it or not, there is a little hangover effect of worrying that, hey, we were slow to tighten. The last thing we want to be is too soon to ease. We don't want to be criticized that we let inflation get out of hand again. So I think they're fighting the last war a little bit, those that are worried about that. Now, Austin Goolsbee is the one that gives me most confidence that he understands that, you're right on the verge of waiting too long if you haven't already gone too far. Um, he's careful not to kind of go against the chairman or go against the narrative that's out there right now from the Fed. But if you read between the lines, I think he is one that's growing concerned that they can't wait much longer. He's probably the guy, if anybody, that's going to speak up in the meeting and make the argument that we could go as soon as now, meaning July 31st. Whether he'll have enough company doing that, I don't know. There are a couple of them, I think, in his camp, and then a bunch of them kind of on the fence, I think.
Yeah, the variance, and I think you highlight a good point there, specifically with regards to building a committee that has diverse viewpoints. Because I see a lot of people latching on to that and saying, oh, like they don't agree with one another. And I think your perspective and the way that you frame that is probably just good for people to hear and put that in their back pocket to understand that the concept of not agreeing is kind of good in a committee to have a cross flow of information and perspectives. Now,
But before we finish, let me just
yeah,
say, Powell gets a lot of criticism. It's the kind of comes with the territory. Um, but I have to say, not only and I've said this before, he's a straight shooter that is not playing politics or not trying to tell you one thing and doing another. He's really telling you what he's thinking and what the group is thinking. Secondly, I think he's not a guy with a big ego that needs the group to agree with him. He's more than happy to have diverse opinions on there. He obviously knows it's his role at the end to make the ultimate decision. But I think people are selling him short if they don't understand that we're lucky he's in that role. That being said, I mean, I have lots of criticism of what I think policy is going to lead to. So, but I think he's trying his darnest to do it right. Let's put it that way.
yeah, and I'm actually also glad that you mentioned that, because I think especially for somebody with your kind of breadth of experience, obviously you can find little chinks in the armor and things that you're kind of like, I don't know if that's the way I would have done it or what makes sense. But at least to take a moment and reflect on the effort that somebody's putting into something, like genuine effort. I think that that's typically good to do just for a general health of conversation and whatnot, because it's so easy to get too entrenched and kind of trounce people for everything. Now, when you look at the way that the Fed is likely to navigate this going forward, now that we seemingly are getting closer to a cut, what's your expectation for how that goes and how the market kind of flows with it?
I Let's put it this way. I do think you're probably going to get three cuts this year, at least. So in other words, if it happens in July, then you get July and September, and you might get a couple more. If it waits till September, you might get one in July and November and December. So I would not be surprised to see at least three cuts this year. Um, you know, I don't know whether they're going to be quarter point cuts or whether they'll start with a quarter and then have to move to a half because things are getting rockier. Um, it's hard to know beyond the first cut what it's going to look like. I will say this: I think the markets are gearing up here. As you know, I've had this melt up forecast for a long time, and whether people understand it or not, this is melt. When you see melt up, that came from me. There wasn't anybody talking melt up. Um, when I started talking about it years ago. So, and now it's coming true. We're in a melt up, as I have said. We really started a melt up last October, and it will just get steeper as we go along. So there's a parabolic stage into the top that is coming, and I think it's coming in August and September. Might even start, now. Um, so I think Fed ease or the anticipation of the end of Fed tightening and then followed by Fed ease is a big reason why we're seeing this thing move up, because it allows investors, particularly institutional investors, to start looking over the trough and start raising earnings estimates for next year and the year beyond. Because if the Fed is easing, the wind is at the economy is back, and you have a better economy and therefore better earnings. That's essentially what's really going on. Now, with that comes obviously the anticipation's already started in terms of Fed ease. So the bond market's already been rallying. We're down to 417, I think, today on the 10-year. I expect the 10-year to get down to 2.5 before the election. So that's you're going to have falling rates, in which helps stock market, helps valuation of stocks. That comes because of the anticipation of the Fed. As I've said, ad infinitum. um, it doesn't matter whether the Fed cuts or not, because the bond market's going to do the cutting. The bond market's going to do the easing, whether the Fed gets it or not. The bond market's already seeing that we need to ease. That's why rates have fallen from 5% last October to 417 now. They went from 5% down to 380, back up to 470. And now we're down to 417 on our way below that 380 at some point in the next month, I think. So rates are coming down because the street does it in the aggregate, not individual strategists or anybody, but the street in the aggregate and the bond market in the aggregate is understanding that the Fed needs to ease and that the economy is slowing. So that lower rates obviously stimulate some activity. It'll help housing, it'll help auto sales, etc. And with rates, I think, coming down a lot more from here, I think that will be some buffer against the slowdown we're getting right now. So even though I think a hard landing is coming in the next year, it's possible that we get an ebb and flow here where it looks like things are going into recession, and then all of a sudden, because of the drop in rates, you get a little bounce in housing, a little bounce in auto sales, and the next month's numbers look better. So it's not going to be a straight line into a trough, or a straight line into a recession. It can bounce around because there are offsetting things going on in terms of policy or in terms of the markets.
Got it. That opens up kind of a stream of questions. To take a step back to a more mechanically focused one, can you walk through the mechanics behind the concept of bonds cutting rates ahead of the Fed. How does that actually play out?
Sure. So just to go back to real basics, interest rates and bond prices move inversely. So when the bond market rallies, rates come down. The bond market in the aggregate means when all investors that are in the bond market act together, so law of large numbers. So it doesn't mean that any individual has figured it all out and is doing it right. It means the bond market in its aggregate is probably a better predictor of interest rates than the Fed. So when the bond market is rallying, it's already anticipating that the economy is slowing down and it's going to mean Fed ease at some point in the not too distant future. So that's how, when I make the comment that the bond market leads the Fed, it's because it can, in its aggregate, look at all the data coming in, the masses of all the people playing in the bond market, all the institutional bond players and bond traders, all the everybody in the bond market. When you put them all together at such a large number, it's an efficient discounting of what's going on, right? It's an efficient discounting. Sometimes they get it wrong; they may discount wrong, but at this point, what they are discounting is a slowdown in the economy that the Fed has probably over tightened or at least has tightened, and it's leading to, we're seeing it in many different economic pieces of data. It's leading to a slowdown in the economy, maybe a soft landing, but maybe deeper than that. And so the bond market, in its infinite aggregate wisdom, is rallying and pushing rates down. The Fed, which has other concerns, don't want to jump the gun too soon. It's a small group of human beings trying to call the economy, is not as typically, I mean, most of the time, is not as good a predictor of the future as is an aggregate market. So I think the bond market in its aggregate is a better predictor of what's coming. And in discounting rates at lower rate, in discounting the market at lower rates, it is saying we think this is going to continue. The slowdown is going to continue. We are optimistic that inflation is going south, not north. So whether the Fed agrees with that yet or not, I think they do. But the bond market's seeing that, and that's where I put my faith more than I do individual economists or the Fed, et cetera.
Got it. And then do you think that there's a reason why, if in your opinion, we might have waited a little bit too long? Why wouldn't have the bond market essentially started to do this earlier? Because I noticed that like 20 years, we started to see a little bit of a tick up, kind of almost like monthly. It started the beginning of January, then we saw a tick up, drop down, back up in Feb, back down, back up early March, back down. And then we kind of fell off a cliff a bit. And then in essentially throughout April. So the summary of that question is, if the hypothesis is the bond market is kind of forecasting / executing their own version of rate adjustment based on the aggregate intellect of participants and their forecasting of things, how does that work with your assessment of thinking that we might have waited too long already? Wouldn't we have expected to see the bond market then rallying sooner than now?
Well, keep in mind, I'm big picture, looking out longer term, and have done this for 50 years. So I may be anticipating things ahead, whereas the bond market is day by day looking at data, and traders are looking at data, and so it's going to ebb and flow. Like I said, the first quarter we came into the year expecting better inflation numbers, expecting a slowdown. In the first quarter, we had much worse inflation numbers for 3 months in a row. And so the bond market reacted to that negatively because expectations coming in were looking for the opposite. Then you got some better numbers, and it was up and down for a couple months where you got some better numbers, but not every number was better. So it kind of had to adjust and wasn't sure which way to go. And then finally in June and July, we've had much more consistently slower economic data or data indicating economic slowing. And the inflation numbers have calmed down and look like they're heading south again. So the bond market's gaining confidence. So it's not that the bond market can see out a year and say, hey, we know what's going to go on. It's constantly readjusting day by day, based on data, but does have kind of a common um, expectation as it goes along. It summarizes it again. It's not a machine or it's not a computer that's putting it all together and spitting out an answer. But in the aggregate, when all the traders and all the bond investors act together, they tend to efficiently kind of discount what's going on.
I see. Yeah, that's super helpful. Thank you.
Thank you.
The next question I had for you is looking at the cut scenario. You were talking about the probability of, successive cuts in a row. My expectation was whenever we see this first cut, even if it's 25 basis points, based on Powell's messaging, I just had this innate instinct that he would cut and then pause and then see about resuming cutting. But based on the timeline that you're talking about, potentially up to 3 almost, there's only 4 meetings left this year. So my timeline wouldn't work well in that case, especially if we skip this coming meeting. So I assume I'm obviously much smaller scope than you. So the reason why I've arrived at that conclusion, or at least the current hypothesis, is just from Powell's messaging. But obviously, you're able to kind of look beyond just what he's saying, and you're looking at the activity of things. So do you think that the rationale for Powell potentially doing these successive cuts is he would prefer these smaller cuts, see how they feed into the system, but kind of maintain progress? And how would that differ than if he did a cut, wait a month, or wait a cycle, do another cut?
Yeah, I obviously don't have any real insight into what really is going to happen, but my assumption is, or the reason I think it's possible. I'm not saying it will happen this way. The reason
Sure.
I think it's quite possible we could see 3 or 4 cuts this year is because I think the economy is going to. I think we've hit the point where the economy is very close to recession if it's
I
not
see.
already hit, and I think generally the data is going to continue to soften. If that's the case, I think you could, by the time you get to the fall, be dealing with the Fed saying, "Hey, we're behind the curveball. We've got to get going. We're behind the 8 ball. We've got to start catching up." So,
I see.
and like I said before, I have no idea whether it'll be 3 or 4 quarter-point cuts, or whether if things start to accelerate to the downside, he says, "Okay, the first cut is a quarter," but then we get to the next meeting and he goes, "We need to be talking about bigger cuts because things are starting to head south." They do not want a recession, right? They've been pretty clear that they want a soft landing. It's interesting. Bank of America's survey came out, I think, today. They survey portfolio managers across the institutional landscape, and it's a pretty good indicator of where institutional investors are. And right now, institutional investors are um, mostly talking soft landing. 11% out of 100%, 11% are saying we could see a hard landing. I think it's in the next year. It might be the next 12 to 18 months, but only 11% of portfolio managers in that survey are looking for a hard landing. I'm looking for a hard landing. I mean, I think I'm looking for a very hard landing. So that shows you that the vast majority are living in the world that we're in today, which looks like a soft landing, right? They're not looking ahead and seeing any problems that concern or that are leading them to say, "Yep, it's going to get a lot worse." I think the Fed's kind of in that same boat of right now, looking at it today, we're in the soft landing, and they're extrapolating out. That is a very common thing in the markets, and I think in the Fed, is to extrapolate what's going on today. I always say that if you looked at it, economic forecasts, mostly they're telling you what happened or what's happened behind you, not what's happening ahead, right? They're extrapolating what just happened. If you're on a very windy road and you're deciding you're going to drive with the rear view mirror, you're going to be off the road, right? Well, that's why economists get a bad name. Oftentimes their forecasts don't come close. because they're looking at they're looking at data which is by definition backward looking. The Fed's looking at data which is backward looking, and then they're pretty much extrapolating it. Now they're not dummies. They can kind of factor in other things if they have reason to. But generally, that's why you get what you get. And then if you get at an inflection point where things start changing rapidly, they've got to change their forecast, and they will. So some of my bet that we could see 3 or 4 cuts this year is obviously a bet that the second half is going to be much slower than the first half. I could be wrong. I'm not. I don't really pride myself on being able to call the next few months, or that's not my game. So, but I still have an opinion, but it doesn't mean that's not where my confidence lies.
Right. Now, it seems like the scenario laid out for the melt up idea is still highly predicated on the market shifting its forecasting whenever it sees a different picture going forward. So we've been in a pretty restrictive scenario for some time now that kind of suppresses a lot of things. So I feel like the idea for the melt up, as you've described it before, seems to like I get the catalyst for it. When we look at the transition, though, from the melt up to a peak, what is it at the peak now that you see as the catalyst, the turning point for the follow-on bust?
Yeah, I don't know. I mean, I can throw out scenarios, I can throw out possibilities, but I don't have any prejudgment right now about exactly what it is, because what I'm still in the melt up. I mean, we've got the Russell. My target on the Russell is 3,300. That's 50% above here. My target on the Nasdaq is 24,000. I did, by the way, I raised that in my last letter from 23,000. So that's 30% from here. My target on the S&P is 7,000. So you're probably 25% from here. So there's those are returns you normally get over 2, 3, 4 years, right? And I'm saying they might happen over the next few months. So yes, we're getting closer, but we're not anywhere near in terms of the runway. The runway is still a long runway to get there. It's a steep runway. I think it happens fast, but so I'm not seeing anything right now other than policy mistakes, or potential policy mistake in terms of being too restrictive for too long. And again, what leads to me calling for, instead of a plain ordinary recession, a global bust is 320 trillion in global debt, quadrillions in notional value of derivatives. We have never, no cycle in all my 50 years, the previous cycles, obviously 2007-8 was the biggest leverage cycle we have had. This one's far beyond that one in terms of leverage. Leverage is not something that leads to soft landings or calmness. When you have leverage and you make a mistake, that mistake gets magnified many-fold. So that's why, I mean, very simply, that's why I'm calling for a bust. Do I know that the bust starts before the end of this year or early next? I don't know that. I think that's the best timing I can have, is to say if we've started a recession already or we're about to get into a recession, then that recession will ultimately morph into a bust where the recession starts getting worse, and that triggers some big financial problems, bank failures and things. And I'm just guessing it's going to take us several months to get there. So I'm saying towards the end of this year or early next year, you could start the bust. And there's no, a recession you can go back and date. A global bust, my definition of a bust is just it's an extreme recession, right? But it's a recession that's accompanied by a financial crisis unlike any we've seen before. So that's why I call it bust. And we haven't had a bust in the post-World War II era. 2007-8 was pretty close to one, but I don't think we really quite got there. So I'm calling for something financially that's worse than that, meaning bigger bank failures, bigger crisis in the financial world. And I'm not talking about the market. I'm talking about the financial sector of the economy. And so it's hard to say exactly when that's going to happen. But I do think there's a pretty good chance it happens, sometime after the election, probably, and between then and sometime in the first quarter of next year. And then I think it happens fast. It's accompanied by what I'm calling an 80% bear market. So peak to trough, an 80% decline in the indexes, which means most everything is going down. If you have 80% down in your indexes, there's not many stocks that are going to be holding up, right? So I mean, it's both a bust, which is the economic and financial side of it, and a bear market, which is the market side of it.
Got it. Yeah, and just to make sure that the question is clarified, the timeline you laid out makes sense. The main thing I was honing in on specifically is the catalyst, and it sounds like the catalyst is leverage. It sounds like that's the main thing that would
Yeah,
cause.
I wouldn't call leverage catalyst. I think is the reason why it worsened, why it is more extreme.
I see.
And it certainly will be why we have the magnitude of a decline that we have. Catalyst could be a lot of things. Catalyst could be a bank fails here or overseas and starts a domino effect.
I see.
It could be an assassination. It could be all kinds of things that can start the process, but ultimately I think it's the process itself that and also from a market standpoint, you reach the top and then you go, well, what determines why it tops and goes the other way? It may be policy to some extent, and it may be just it burns itself out. You get to a point where you've got such extreme speculation at the top that it rolls over a little bit, and then you think, well, it's rolling over, but it'll come back, and then it doesn't come back. It goes down another leg or another bit, and then bounces, but not all the way back again, and then goes down further. So it can kind of on it can kind of the market itself can kind of start unwinding on its own without any true catalyst. Ultimately, you'll look at the catalyst being the bust, the bust delivering very poor earnings. I mean, the earnings are going to go through the floor. But initially, it's how it starts is it can happen kind of organically.
Got it. And that part I actually find fascinating, where you say it could happen organically. I think I get your meaning there. I think the reason why I'm so fascinated about understanding the catalyst or the severity part makes sense. The way you delineate those two, I'm following. Kind of breaking out leverage as a severity metric as compared to the forcing function of things. But based on the way that you describe the global bust, to me, it doesn't sound too organic. It sounds like something that 80%, to your point, is something we haven't seen essentially post World War II. So I find it fascinating. I get the idea of a market top. I get the idea of natural pullbacks like you're talking about. But for a natural pullback to then turn into this depressive event, I don't know if you go as far as calling it a depression. It seems like 80% crushed earnings, probably a decent duration that we might spend there. So I guess to maybe reframe the idea to try to understand better, when you look at the concept of us potentially hitting a market top, starting a pullback, when in your mind does it turn from pullback into this global bust?
Yeah. Okay. So, well, you're mixing things because I'm
Okay.
on Twitter. I do this all the time. Keep the bust entirely. Bust refers to the economy, doesn't
Okay.
refer to the market. So bear market. When does it turn from a pullback to a bear market? First of all, let me say, when I say it can start organically, it could start with some catalyst, but if it starts organically, all I mean is to say is that it could start rolling over, just like some of our pullbacks do, and you don't have any real thing to pin it on until after the fact. You look and say something's happening. The bear market itself won't be organic. The bear market will be driven by the bust. The bust means a very awful economic cycle, down cycle, accompanied by potentially the worst financial crisis in our history, worse than 2007-8, in other words. And what that does is it turns earnings um, far south. So we'll have pretty lousy um, earnings, you know, and stocks are driven off of earnings. Interest rates will be low. Now there is a period where rates could back up, as I said. During the melt-up, rates come down. You could have, for any number of reasons, a bounce in rates that could coincide with the turning in the stock market. So that can happen. We don't know what the Fed's going to do. The Fed may react wrongly, in my opinion, but they may react to the stock market. I've said this before, where if you get the stock market up to 7,000, Powell may go back to that Dudley idea that, hey, stock market's part of our process. If we let that run away, it's going to lead to inflation or hyperinflation. So he might tighten, even though the economy's not looking great. I have no idea, because in the past he's paid too much attention to the market. Lately, he hasn't been. Lately, he's let it go. But if he goes back to saying, hey, the the stock market's way up on stilts, we need to tighten. He could bring on the bust by zigging when he should have zagged, by tightening when the economy is about to go into a hard landing, and then that just exacerbates it. So, I think all of that is still to come. I don't worry too much about. It's kind of take it one step at a time, trying to jump ahead and anticipate exactly what's going to cause what. Um, you know, More often than not, the scenario you draw up isn't the one that happens. It's something else. So
Right.
I'm always looking at the potential catalysts or potential problem spots, but I recognize that if we're still as far away from the top as we are, let's worry about that first and then get there.
Yeah.
As we approach 7,000, you can be darn sure I'm going to be saying, is this the top, or do I have to extend my targets? And if I'm not going to extend my targets, there must be danger signs I'm able to see at this point. So it's between now and, I think between now and October, I think there's going to be a lot of that going on.
I see. It makes a lot of sense. And yeah, thank you for kind of just offering a glimpse into what you're looking at. Totally understand the point of focusing on what's in front, near term, being more of the expansion phase. I think understanding a little bit about what you were looking at and what you just shared there is actually even that very helpful, because you offer a wide array of things, right? You didn't come back and say, this is the only kind of thing that I see that could cause this. It sounds like a very broad potential that can be kicked off by several factors, which even that in and of itself, I think is quite informative, actually.
Yeah, I've
You,
been pretty clear that I use a shorthand formula and say the global bust is caused by over leverage,
right,
heavily over leveraged system, plus fragility in the system, in the economy. And again, this is global, so it's not just here, but that was caused by the pandemic. I think we've gotten away from the pandemic far enough, and obviously have a tremendous bull market, that's easy to forget that there's still a lot of hangover effect from that pandemic. There's a lot of small businesses that are hanging on by a thread, and many others that aren't hanging on anymore. There's labor issues. There's all kinds of things out there that I think under the surface are not being paid attention to because things look okay. But there's a fragile economy because 4 short years ago we shut down the economy, the world economy, and it led to some things where lots of places are still trying to get back on their feet or doing things differently. So leverage plus fragility plus a potential policy mistake, meaning probably over tightening on the part of central banks, not just the Fed. And that's my shorthand of what causes the bust, with the leverage being probably the
right.
biggest thing that makes it bigger. But there can be any host of things that kind of add into that aren't necessarily apparent yet.
Got it. Yeah, that makes a ton of sense. You mentioned before in passing that a potential thing to look at could be an assassination, and we almost saw one pretty recently this past weekend. I wanted to get your thoughts on that. Like we talked about before, not looking to get political. It's not really about that. It's more about the impact that that event you may or may not think could have on either the election cycle and then the subsequent impact that the election cycle and whoever wins that would have on the markets.
Yeah, I think there's certainly probably people out there that believe that this rally this week is a Trump rally. I don't know that. I mean, I'm because of my view that this was coming, and I saw this. I mean, I was getting 2 weeks ago. I was getting day by day people coming in and saying you're crazy. Your Russell forecast of 3,300 is never going to happen. You know, the Russell's going down, not up. And every day they, you know, the same people, I talk them off the ledge, and they'd come back the next day because the Russell was down a couple points again, and they'd come right back and say, "There's no way the Russell's going to rally. You know, what are you talking about? What, you know, it's a crummy AI rally. It's not anything else." And I'd say, no, this is going to broaden. Under the surface, we're already seeing some broadening, and the Russell looks great to me, and it did look great technically. And sure enough, you know, this week we've taken off. You know, the Russell's up 10% or whatever, and all of a sudden those voices are silent. But you know, I saw this coming. You know, well before Trump was, you know, shot at. So it's hard for me to say the rally this week because technically it looked like it could be coming. It's hard for me to say this is a, you know, it's the result of Trump, but I think there's possibility that some of this is people seeing that the odds are increasing, that we're going to have Trump in the White House instead of Biden, and it's a more pro-capitalist policy. So you may be getting some of that on Wall Street, but I really don't think that's the big story. Whether it's this week or not, it's not the big story of why I think we're going to 7,000. I've said pretty consistently, starting last year and into this year, that my forecast has zero to do with the election. I don't,
Got it.
even though it's an election year, and that, you know, you can look at election year statistics and stuff. I don't really think that what we're seeing has much to do with the election. And I'm, you know,
Quick clarifying question on that. Sorry. I just want to explore the inverse causal relationship. So not so much the election having the election essentially causing this scenario, but do you think that there's any sort of impact that the election can have on the severity or the magnitude of what you're seeing or expecting?
um, I don't think so. Like I said, my
Okay.
targets have been in place and are in place, and they really aren't factoring in that. Now, that's not to say, you know, we're living in a crazy world. You know, there's been one assassination attempt, and there's reasons to wonder whether it was just you know, what it was presented as, or whether this was, you know, the other side has said many times we have to do whatever we have to do to stop him from winning the election. You know, the deep state theories and things. So I don't want to get into it too much, but it's not impossible that this was something that's far bigger than just one lone gunman that, you know, the Secret Service made some mistakes on. And if that's the case, you know, it may not be an isolated case. We may see another attempt. So, and, you know, who knows what happens. So I'm not saying that those things can't happen and that it wouldn't have an impact. But as things stand right now, you know, everything I'm forecasting is based on, you know, the Fed fundamentals and the economy and
Got it.
financial system. So whatever comes, I'll adjust to it. But I just don't, you know, I don't think that's the real main reason for any of this.
Got it. Yeah, makes sense. Couple last questions for you. What what are your thoughts on the performance of metals so far this year and really commodities in general? I know a lot of times we'll spend some time talking about metals, but just to broaden it out beyond just metals and think about commodities as an entire group?
Yeah, well, first of all, the metals have begun a very big run. It's been a long time coming. I took a lot of abuse as a bull on the metals for a long time, but gold broke out above 2100 many, many months ago, and as you know, it reached a plateau and corrected from there, and is now on another run. I think we're going to 3,000 pretty quickly in gold, meaning the next few months. Silver's farther back from its all-time highs. Gold's at all-time highs, but silver's got to get through a lot of various levels of resistance. So it's got a longer ways to go. But I raised my target to 75 on silver, and I think it's it could spill into next year, but I think it's potentially a 2024 target. So that's a long way. I mean, where are we? 31 and change on silver. So you got a big run there. And the miners obviously will accompany that. So I'm a huge bull on both gold and silver. I'm also bull on copper. I have a $6 target on $6 earnings number on copper. So there's and I think the copper producers are looking very good here. So the whole metal structure looks good. Other commodities, ag doesn't look so great. Wheat's down at lows, multi-year lows. Corn's heading south, is pretty low and heading south. Beans are heading south. So I think the grains look very deflationary, and I think they will get hit harder, and they'll keep going in the bust. So there are aspects of commodities that are doing okay, metals obviously, but other commodities not so great. Cotton looks negative to me. Lumber's been weak. So you've got I think basically those that are worried about inflation, I think, are worried about yesterday's problem. I think what I see a lot is more deflationary in the picture. Now, not that they're in deflation yet, but if we get a bust, this stuff's going a lot lower. Gold and silver are I mean, copper's a temporary thing, right now. I do think copper will get hit and could go as low as $1 in the bust. So it's on its way. It's got up. I think it got up over 5 and then corrected back to the mid 4s on the earnings, or on copper, not earnings, on the price of copper. And I think it's going to 6. From 6, probably later this year, I think it can go down maybe as low as $1 in the bust. So it's kind of a last hurrah. But I think it's looks good here. Trying to think of some of the other oil. Okay, oil's one that kind of doesn't fit the metals. I mean, oil I'm bearish on. As you know, I've been bearish on oil when most people are bullish. I'm still calling for $60 oil probably this year, and then in the bust, I think it can go down to 30. So and then the commodity story, the real commodity story, is post bust. Once we get beyond the bust, with all the money that'll be pushed into the system to save the system, 20 trillion here and big amounts everywhere else, you will see inflation get up to 25%, I think, by the end of the decade. And as a result, I think you're going to see, commodities go through the roof. All that money is going to stimulate demand for commodities, demand for industrial products, and so commodities are going to run very high. I mean, you're going to, like I said, oil can get to $500, silver can get to $500, gold can get to $20,000. Natural gas maybe could go to $50. I don't know. I mean, I think natural gas is $2 now and probably going to be $1 in the bust. So, I mean, there's a big change coming after the bust in terms of commodities.
I have to say, one of my favorite things about talking to you, to be completely honest, is
I'm crazy.
It's not. That's the funny thing. I haven't been in markets anywhere near as long as you have. I've been trading for 16 years now, but it's a far cry from, your experience. But what I have noticed over my time in markets is that weird things or things that are seemingly impossible or improbable happen all the time, literally all the time. And they happen way more than they statistically should. So, one of the things that I love hearing from you is when you run through these different ideas, when you say something like oil to 500, it's like my brain is racking trying to even like understand what that could look like. So, it's like eye opening for me to even think about the numbers, to think about what the landscape would look like in that scenario. So, a quick question, then I know that we're coming up on time. I don't want to keep you too long. But when you look at the flow of commodities through that, what do you think the impact would then be on the broader economy? And then how, again, and I know I just want to be really clear. I know that you're talking about focus on the up move first, and then this is all
Yeah, but
further.
I don't have any problem talking the bigger picture on this because it's
Okay, got
important.
it. Because I'm just fascinated by how this would work. So, what would the picture between the commodities look like and the economy as the basket of commodities kind of goes to two different spots? How does that impact the economy while it's like that, while things are that defunct, while oil might be up to $500, while inflation could be at 25%?
It's a huge thing because um, keep in mind we're going from we had an inflation worry, then the Fed reacted, and now I'm saying, now I could be wrong, but I'm saying next year, because of the violence of the bust, because of how extreme it will be, it will take us actually into broad-based deflation. So next year we'll actually have negative inflation. Then all that money gets created to get us out of that, and it'll be money and debt. They'll be issuing all kinds of treasury bonds and bills. All that stimulus will then jumpstart a recovery with a lag. So let's say the bust lasts all next year. Sometime in 2026, we begin recovering. We may not feel like it, but we will begin recovering. Statistically, we'll see GDP moving up. And usually the first couple of quarters out of a trough, GDP is up pretty big. I can remember in the early 80s, we had GDP up 10% in a quarter. When you stimulate like crazy and you're coming off a low base, the numbers can jump pretty fast. So we'll have a period there where you have a pretty good recovery. Inflation will lag. Usually inflation's a 12 to 18-month lag, more like 18-month lag. So if you're in deflation, it'll probably be 2027 before inflation starts really looking like it's starting to pick up speed. It might be low single digits for the next year, and then 5 or 6% on its way to double digits by 2028. So it'll start accelerating, I think, because of how much money we're talking. It may accelerate faster, so it could come sooner, but it'll be a year or two anyway before you get into double digits, and probably longer. But then once you get there, you'll double and then double again. So prices are just going to go through the roof because you've pumped all this money in that creates demand for products, demand for it'll be an industrial recovery because the consumer is going to be still digging out from the bust. They're going to get hit hard if their wealth goes down 80%, and their real estate goes down 30 or 40%. So they're not going to be in any mood to spend a lot. But we're reshoring and we're doing a lot of things that are going to be pro-industrial. So industrial spending, capital goods spending, is going to be strong. That means you're going to have demand for steel, you're going to have demand for copper, you're going to have demand for nickel, you're going to have demand for all kinds of commodities, and yet you're going to get, because we've sized down commodities over the last few decades because it was a consumer economy and we didn't have the demand for commodities we used to have. So we've rationalized down the capacity. And you've also run out of a lot of minerals and metals, and things are hard to find now. It takes years to develop new sources, right? New mines and things. You're going to have a case where you're going to ramp up demand fast in a year or two, and you can't ramp up supply for 10 years, 7 or 8 years. So that means you're going to have demand way outstripping supply. And that's true of oil, that's true of metals, that's true of a lot of commodities. And so the price, the only thing that can give when you have demand way above supply is the price. And the price will go through the roof. So that's why you get that. Now, the problem is, in reality, you can't, you can't adjust incomes fast enough to keep up with that, right? So if inflation's double digit and moving to high double digits, people's incomes are going to get just like we saw at a lower to a lesser degree in the last few years. People's incomes are stretched because inflation's eating them alive. Food prices are up, and price of cars are up, and the price of travel's up, and the price of gasoline's up. That's going to be that on steroids. You're going to have gasoline prices at who knows what, $15 or $20 a gallon. You're going to have, heating oil prices through the roof. You're going to have, car prices probably high because of the cost of goods to build them. So you have all those things. And at the same time, you have a consumer who's kind of flat, still on his back because of what happened in the bust. So it's not going to be an easy time for people. Now there's going to be a have economy. Of course, there's going to be 10 or 20% of the people that are going to be saying, "Hey, I'm in good shape. What are you worried about?" But the have-nots are going to be a lot larger component than even today, which is a large component, 40 or 50%. So that's a problem. The other problem is that if you get inflation up to 15, on its way to 20, on its way to 25%, you're going to have T-bills up to 15, on the way to 20, on the way to higher. And you're going to have T-bonds up to 15, on the way to 20. When you have rates like that, and you already have a $34 trillion debt, right? The $34 trillion in Treasury debt. That's just U.S. Treasury debt.
Yep.
If we get 20 trillion in new money, we're probably going to have 20 trillion in new debt, because they'll put it out with one door and then buy it. The Fed will buy it, monetize it in the other door. So you could be up to 50 or 60 trillion in debt. We can't service 34. We probably can't really service 20 trillion, and we can't service it at 5%. What are we going to do when it's 15 or 20%? It's already a larger, servicing our debt is already larger than our military budget, right? Imagine if it's 4 or 5 times this. That's our whole budget, then some. That's so what I'm describing is an equation that doesn't balance. And that's why we collapse. At some point in the 2030s, we're going to collapse. And not just the US, this is a global collapse. What I call it is the end of a 80-year Ponzi scheme. We've borrowed and printed for 80 years. And each cycle we had more imbalances, more excesses. So it required more money and more printing, more printing of money, more debt to keep things going. And then it required, so that's why when you say, things that you wouldn't ever think would happen are happening, and it's, things you would think were impossible happen, it's because we're at the end of a super cycle. We're at the end of an 80-year long cycle, 80 or 90-year long cycle. So we're in the last decade. And in that last decade, things just get much more extreme in both directions. So you go from bust to boom, you go from boom to bust. So it's not a pretty picture. It's really the guidepost for me in terms of why I'm so confident in pushing out things that seem crazy, is because I saw this coming, years ago. I saw where we were and what was probably going to be the end game, how the last couple decades were going to play out. And they're pretty much playing out according to my script, unfortunately.
Well, I got to say, I mean, what a mic drop to end on, because there's a million questions I have to go off of that, but I'm sure you have other things to do, so I'll let you run. Obviously, I will share a link to your Twitter account, the correct one. I know that there's some imposters out there, as if they could be you. No chance. So I'll throw the link to the correct spot, and I also know that you do your newsletter. So if anybody's interested in that, they can shoot you a DM, and then you can give them details on your newsletter. But I really want to thank you for spending a little time going into some of the weeds. I know some of this stuff is duplicative, triplicative for you. I know that you've talked about this stuff a lot. But what I like to do is after the podcast that we do, I try to collate what people are curious about, what elements. And to be honest, I throw out 90% of it because I always say he's said that thing 65,000 times. You can go find that on his Twitter. But I try to bring some of the nuanced questions. So thank you very much for spending a little bit of time going into some of those details, sharing more about your thought processes. I try to remind everybody a really massive thing is to just listen to the way that you synthesize information, what details you're connecting in what way. It's super informative. It helps people understand how to think about things, and it gives them another model to use. So thank you very much for sharing all that, and thanks for hanging out for a while.
Yeah, if I can just say at the end that
Please.
because we are getting so much longer into this, so much closer to the end, that as I say, it's a unique period or a unique thing to say that we're still 30, 40, 50% away from the top in some of these indexes, and yet to say it could be just a few months away that we're at the end of this. So you have to understand that this is an unusual period where normally I would be the first one to say, you're a few months from the top. Nobody's smart enough to pick the top. You ought to you ought to start getting defensive now, or you ought to start planning for the other side of this now. The problem is the way psychology works. If people do that, and then you have another 20 or 30% upside, they're going to get drawn back in, or most people are going to get drawn back in saying, well, how does he know that's the top? Maybe there's going to be plenty of narrative out there saying this thing has a long ways to go. So you're going to get out, let's say at 5,600 on the S&P, and then you're going to be forced back in because of the pressures on yourself psychologically at 6,500 or 7,000, and then regret that you bought at the top. So it's easy to say, well, I'm not smart enough to pick the top, so I'm gonna get out early and just sit on it. If you do that, and that's fine. If you do that, know what you might be missing. And as long as you're aware of what you're missing and you're happy to do that because you don't want to take the risk, because the risk, as we get this close, the risks are getting high. I mean, we could have a president shot tomorrow and the market could go down 1,000 points. So I'm not forecasting that in any way.
Of course.
But I'm just saying, yes, we're closer to the end, so the risks are rising. But it is that unique period where we've never had this kind of a magnitude of rally coming in the last stages. I mean, this is a very unique historical rally. I think, in my opinion, this is going to be the biggest rally in history in a short time. So,
cannot wait to see it. I literally cannot wait to see how this plays out. I really enjoy learning from you. Thank you so much for sharing your experience. Obviously, I will reach back out to invite you back on to get another update. It'll be about a quarter, so we'll see. That could be a really spicy time to do a follow-up.
Sure
we might be right hanging out at this inflection point, which would be really fascinating to explore together.
Of course, October's always got some historical significance in markets. So
yep,
yeah, it might be interesting.
Well, awesome, David. Thank you so much for hanging out. And for everybody else, thanks for watching and listening. And don't forget, be an outlier out there. Pay attention to what you're doing. Stay safe with your risk. We are in a busy time coming up per David. So thanks, everybody.
Hey, have a good summer, Eric.